For those of you who are worried that the stock market may have gotten ahead of itself, for anyone who's concerned that stocks in general are too expensive, why don't we take a look at a slow but steady grower that's much cheaper than the average stock of the S&P 500. I'm talking about Unum Group, UNM, the largest provider of disability insurance in both the U.S. and the U.K. Also has a substantial business selling group life insurance, voluntary benefits, along with cancer and critical illness insurance. Unum mainly sells this insurance through employers, mostly small to medium-sized companies. Their business is much more underwriting-oriented than most of the life insurers. Basically, Unum is a stable company that steadily collects premiums over a long period of time, generally ends up paying out benefits at a predictable and consistent rate. Now, at a time when so many stocks have rallied so much, Unum has pretty much done nothing so far year to date, and it sells for just 9 times next year's earnings estimates. That is pretty darn cheap, given that the company has an 8.5% long-term growth rate. Plus, this is a shareholder-friendly company with a 1.6% dividend yield and a solid, consistent buyback that could retire $500 million worth of stock this fiscal year. Pretty huge, given that this is a $9 billion company. Could it finally be time for insurance companies like Unum to have their day in the sun? Let's take a closer look with Tom Watjen. He's the president and CEO of Unum Group, Unum Group, to learn more about how his company's doing and where it is headed. Mr. Watjen, welcome to Mad Money. Thank you for coming on.
Thank you so much for having me, Jim.
Tom, this is one of the reasons why I was so excited about having you on, is because most people do say, I missed it to stocks. I'm trying to understand, you're a company, obviously, that not only says, listen, you didn't miss it, but we're going to buy every share unless you take it higher. That seems to be your approach, given the book value of the company.
That's right. I mean, when you think about the story at Unum, there's really 2 pieces to it. I think you mentioned it in your opening comments. We've got a very good set of franchises, providing a very basic set of protections to individuals in the workplace. We think that's actually a very good business, and if you manage it in a very disciplined way, it will produce excess cash flow. Then, as you point out, the second piece of the story is we've actually shown that we take that excess cash flow and return it to shareholders through dividends and through share buybacks. And that's been the 2 elements of our value proposition for shareholders, and we've done it consistently over the last 7 or 8 years.
Ever since I mentioned that we're going to have Unum 1 today and Squawk on the Street, I heard the same thing, which is that, geez, I don't know, with the disability, with care, with long-term care, which there's discontinued, but with the Affordability Act, Obamacare, who knows whether they're doing well or not? It seems like there has been some confusion that has hurt you over the Affordable Care Act.
It has, I think, but it's been more of a revenue distraction than a risk distraction, actually. Because, again, if you think about what employers were going through here the last 12 to 18 months, they're trying to figure out how to respond to health care reform and what do you want to do for your employees. Actually, the brokers and intermediaries who sell our products have also had to work with their clients to help them understand the new health care environment. So I think in many respects, they deferred their decisions around the benefits that we actually sell. We've already seen a turn in that, actually. We think we're back to a more normalized environment. People are getting back to doing business. They need benefits for their employees, and we've seen that actually turn quite handsomely the last couple of quarters.
Do you think the government's going to get involved in your actual business?
I don't think they will. I mean, obviously, we worry about things like that, like we worry about anything in the environment. But frankly, there's no indication that the government wants to get into this business. Actually, quite the contrary. As you know, they're already kind of technically in the business.
Right.
They provide a safety net for those individuals who don't have disability insurance or accident or life insurance. That safety net's called Social Security Disability. And in fact, that's there in a way to help those who don't have access to private solutions like the ones we provide. So they're already in the business. But I think, if anything, as you know, with the deficit issues and the problems being faced by the government, I don't think the government's looking for ways to spend more actually on these benefits. And I'd say it's both true in the U.S., but also in the U.K. as well.
Okay, well, it seems like once you have a contract, you keep the contract, even if it's repriced. It seems like there's tremendous satisfaction among the customers you have. And if more small to medium-sized businesses were formed, that would be an additional pop to your business.
Absolutely. And again, just step back at a macro level, 70% of Americans don't have disability insurance.
I know, it's really pretty amazing.
And so you really look at that whole fact, and yet at the other side of this, you look at the fact that roughly 75% of consumers would tell you if they're out of work for 3 months or more, they're going to face financial hardship. Just look at those 2 facts, and that's really what creates the opportunity for our company. And as you said, we have a big business in the UK. It's basically the same concept in terms of market environment and market opportunity.
Do you think some people, Tom, are worried about that legacy long-term care business? Because it's really hard people to get those staffing people. It costs a lot of money.
That is the issue, Jim, because if you think about the capital of our company, 70% of our capital is behind these good businesses we're talking about. Tremendous growth, very good performance, good consistency, good dynamics, both operationally and financially. That capital, by the way, is earning about a 14 or 15% on that 70% piece. The other piece, as you mentioned, is we have a set of legacy businesses. About 30% of our capital is earning between a 2 and a 3%. And so from a shareholder point of view, a lot of the focus is really on the closed block. How's that going to perform, especially in this low interest rate environment? Because again, we purchase fixed income securities to support those those reserves and those liabilities in this low interest rate environment is not helpful. So I'd say the investor attention is more around what's going to happen with that block than it is with the high performing.
But if rates were to go up, it would be a spur.
Absolutely.
All right.
Absolutely.
I just think there's a lot of ways to win here, and I'm tired of hearing people tell me, hey, listen, all the stocks are expensive. Your stock is very inexpensive. Thank you so much for coming on and explaining the story.
Jim, thank you so much for having me.
Excellent. Okay, that's Tom Watjen, the president and CEO of Unum Group. There's lots of presentations. If you're saying to me everything's too expensive, here's one that's too cheap. Mad Money's back into the break.